A derivative is a financial instrument whose value is derived from the performance of an underlying asset, index, rate, or other financial instrument. The value of a derivative is linked to the changes in the price or value of the underlying asset. Derivatives are used for various purposes, including hedging against risks, speculating on price movements, and gaining exposure to different markets. Here are some key types of derivatives and their characteristics. Futures contracts. Futures contracts are agreements between two parties to buy or sell an asset at a predetermined future date and price. These contracts are standardized and traded on organized exchanges. Futures are commonly used for hedging purposes, allowing participants to manage price risks. Options contracts. Options are financial contracts that gives the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specified time frame. There are two main types of options: call options and put options. Options provide flexibility for investors and can be used for speculation, hedging, or generating income. Swaps. Swaps involve the exchange of cash flows or other financial instruments between two parties. The most common types of swaps include interest rate swaps, currency swaps, and commodity swaps. Swaps are often used to manage interest rate exposure, exchange rate risk, or customize cash flow arrangements. Forwards. Forwards are similar to futures contracts but are customized agreements between two parties. Unlike futures traded on exchanges, forwards are traded over the counter, OTC. They involve a commitment to buy or sell an asset at a specified future date and price. Credit derivatives. Credit derivatives are financial instruments that allow investors to manage credit risk. Common types include credit default swaps, which provides insurance against the default of a borrower or a credit event, and credit spread options, which derives value from changes in the spread between different bonds. Commodity derivatives. Derivatives related to commodities include futures and options contracts tied to the prices of commodities such as oil, gold, or agricultural products. These derivatives are used by producers, consumers, and investors to manage exposure to commodity price fluctuations. Equity derivatives. Equity derivatives derive their value from the performance of individual stocks or stock indices. Investors use these instruments for hedging, speculation, or portfolio management. Two main types of equity derivatives include equity options and index futures. Volatility derivatives. Volatility derivatives are linked to the expected future volatility of an underlying asset. They include VIX futures and options. Tied to the volatility index, VIX, and often referred to as the fear index. Implied volatility swaps. Derive value from changes in the expected volatility of an underlying asset. Derivatives play a crucial role in financial markets by providing tools for risk management, price discovery, and liquidity. However, they also involve potential risks, including counterparty risk, market risk, and leverage risk. Due to their complexity, derivatives require a good understanding of financial markets and risk management strategies. Derivatives are used by a wide range of market participants, including institutional investors, corporations, and individual traders.